kick off with some of the big themes here on the mountain this week. It's Trump, it's fiscal and monetary policy, it's geopolitics, climate change, AI and the intelligent age. But let me start with the US president first up, because no tariffs from day one under executive orders, particularly no blanket tariffs on Europe. Is that a welcome reprieve?
It's what I expected. And I think it's a very smart approach to the matter of trade, because blanket tariffs are not necessarily giving you the results that you expect. And I'm not sure exactly what result is expected, whether it's a transactional tool, whether it's going to be a pure trade tool. But I'm not really surprised. But it doesn't mean to say that it will not happen. I think that it will be a more selective, focused development that we will see in the next few days or weeks. But I think what we need to do here in Europe is to be prepared and anticipate what will happen in order to respond.
Well, Europe has been striving to keep its borders open, not just as a moral principle, because it also benefits from trade, and particularly with the United States. If we look at the surplus, it was almost 1% in 2023, thanks to strategic important areas that have been identified by some banks, for instance, from chemicals to pharma. To that point, does Europe have leverage in its trade negotiations with the United States?
One point first. You mentioned, rightly so, the lowering of barriers in Europe. And that was the initial project of the single market. We created, back then, a single market, that was the intention, where, nearly 400 million people could consume, travel, transact. But we did not finish that job. And I think that that's one first lesson that we should draw from the current situation. We have this very large, sizable market with plenty of consumers that are prepared to activate their purchasing power and use their savings. So I'm focusing on Europe because you started with the barriers. We still have barriers. Despite this single market aspiration, we have barriers that prevent services and sometimes goods to travel without impairment. And I think it's one of the points that Ursula von der Leyen, the President of the European Commission, made yesterday. Let's make sure that we remove the barriers over which we have control. So I hope this is what happens in the next few weeks, and it's one way to respond to the change in the trade policy in the United States that we should anticipate. It's be strong at home and make sure you transact, that you sell and purchase at home, that you save at home, and that you invest at home. Not to say that we want to move into a protectionist approach, because what lower barriers has taught us is that trade is actually very helpful.
Indeed, there's been a lot of soul searching. I want to explore that a little bit more about European competitiveness with you. But in the meantime, we could be counting down to some form of a trade tariff regime. Can Europe withstand a trade war with the United States in 2025? And how should the bloc engage with Trump if he is determined to extract a price even from allies?
I think in all circumstances, the dialogue has to continue, and the respective parties have to sit at the table and see what is their respective agenda, what strength there is on each side, what weaknesses there are. And frankly, if you look at it from an economic perspective, this theory of substitution, in other words, I will lower imports from Europe to beef up manufacturing at home, is questionable. Because the US economy, and that's the beauty of it, is almost running hot at the moment. If you look at the labor market, you have a very low unemployment rate. If you look at the capacity, it's running almost at full capacity already. So that idea that you can manufacture what you will not import anymore, or that you will import at much higher prices, is something that will take a bit of time.
But could the US import at lower prices? Because there's a real narrative that nobody wants to attract the ire of Donald Trump. So perhaps some of the manufacturers will carve back their margins and lower their prices so they can still sell into the United States, namely China, for instance. If that is the case, is there anything wrong with the United States enacting tariffs for its own economic benefit?
I'm not sure that the importer is typically a US company, right? And I'm not sure that importers can run a business for a very long time at very reduced margins. So at some point in time, the buck passes to the consumer. That's what normally happens in business.
I want to ask you about European competitiveness and this landscape. You mentioned the European Commission President Ursula von der Leyen. She did warn that a new global fracture was starting to form, that these fractures were coming up along new global lines as Trump threatens to revisit trade policy, defend some of those relationships. Do you agree with her? Do you think those fractures are forming across the landscape globally?
I think we have seen fragmentation already, and not only since January the 20th. It started much earlier than that, both in terms of technology, but also in terms of geopolitical forces. This is probably going to be accentuated. My take is that we should understand what each other wants, and we should do what we can in order to find this new equilibrium where it serves everybody's interest, and at the end of the day, the consumers, the savers, the voters.
The European competitiveness story is something we spoke about all last year, thanks to Draghi's report, Letter's report. There was so much soul-searching.
Last year, he released in September. Come on.
And the Letter report. I remember from the IMF World Bank meetings in April in Washington, D.C., we were talking about some of the reports back then and what could be forthcoming. But what reforms did we see? And here we have another wake-up call. Every European CEO is talking about it. How much urgency and how much action, crucially, do you see ahead for 2025?
I'm reasonably optimistic on that front. Why is that? First of all, the diagnosis is done. We don't need another massive report. The Draghi and the Letta reports are excellent pieces of work. It harnesses a lot of data, information analysis, and the diagnosis is there. We know that productivity has to be improved because demographics will not change overnight. We know that innovation will fuel it. We know that money is needed. What's needed now is action, action, action. And typically Europe, when you look back at history, and we have a short history, but typically it moves when, number one, there is a threat, and clearly the changes that are anticipated out of the United States policies is a threat, so a push for action. I think this push is here, and it will flourish and be demonstrated over the course of time. That's number one. Number two, when we have an institutional setting that is favorable. Now you will say, well, 27 member states, how are they ever going to agree, because it's always contentious and they put their vested interest first. Something interesting, the 28th member state. It's a point that the President of the Commission made yesterday, which we have also raised as an option. If you want to sort of not do away, but reach a platform which is simple, straightforward, where investment is easy to do, and where capital can be raised and talents can be attracted, let's go for that. So if you have the push, if you have the institutional setting, and if you have the understanding that productivity is really an issue, and we cannot go on like that, and we cannot stand still. So I think some of the ingredients are really now coming together to push us to actually do something.
And then there's self-sabotage, regulation. I mean, we're talking about the threat of tariffs, but in some ways Trump can pack a punch purely by lowering regulation, and from a number of aspects. I'll give you examples. Climate change, emissions targets that he's now changed for auto manufacturers, the same auto manufacturers that are struggling to compete with those US names. Energy supply being bolstered. We've got softer banking regulation on the way as well. These are alarm bells for Europe in some ways around too much regulation, hampering industry. Does that regulation need to be pulled back to try and bolster Europe?
I think that if the European regulators put as much energy in identifying overlap, overlayer, additional this, additional that, and removing those to make sure that we do have a solid framework that protects the consumers, the savers, the voters, from the next financial crisis, from product hazards, from the devastating consequences of climate change, as we saw in California, as we saw in Valencia. I think that might actually provide not necessarily a level playing field, but a playing field where actors will actually compete in a fair way. And I think Europe is prepared for that.
I want to push on to monetary policy with you because 2025 has been an eventful year. We've had equity markets soaring in some areas thanks to the Trump trade. Bond markets rattled, though, around the prospect of inflation returning, at least in the United States. All this as Europe started to focus on its profile for growth and stepping away from some of those inflation threats. What is the concern of inflation for Europe if we do see it reigniting in the United States?
Well, if there is reigniting of inflation in the United States, it will be an issue for the United States for sure. And I think that's where the first and prime consequences will be. As far as we are concerned, when I look at inflation, and I've seen the full cycle, I started my job with very low inflation, interest rates in negative territory. And then we saw it just climb to 10.6% at the most, and we are now down to 2.4%. And we are confident that we are seeing inflation at target in the course of 25. So I've seen the full cycle.
It's been wild.
It's been the Wild West of inflation over the last 4 years. But we are I think now confident that target is in sight, that the disinflationary process continues, and we are not overly concerned by the sort of export of inflation to Europe. There will be interesting phenomenon that we will watch. The exchange rate, for instance, will be of interest and may have consequences. But we are certainly interested to see the US grow, because growth in the US has always been a favorable factor for the rest of the world.
We spent a lot of 2024 anticipating policy divergence, but do you think that was simply just delayed to 2025? Could that be a big feature this year?
No, we do have policy divergence in terms of monetary policy, because we certainly did not reduce rates at the same pace. Markets anticipate vastly different monetary policy moves in the next few months. So we do have that divergence that has to do with a different economic setting at the moment between the US and Europe.
Now, some of the members over the Governing Council were debating a 50 basis point rate cut at the end of last year. I spoke to about 3 of them saying it should be a point of discussion. They were worried about growth, and in fact some of them were worried about keeping that 2% inflation target over the medium term, that in fact you could be undershooting. Your own chief economist, Philip Lane, was acknowledging too that perhaps rates need to keep coming down. To your mind, what is the risk of price stability and some of the downside risks that you could face this year?
We're not anticipating that, and our baseline is certainly not delivering that kind of threat. But, risk is to the downside when it comes to growth, and we'll have to be very attentive to the data that we are receiving, collecting, and analyzing to see what needs to be done. But we are on this sort of, regular, gradual path. Disinflation is coming through. We'll be looking very carefully at services, at wages, at the sort of what we call the late comers, like insurance and things like that, to see whether the early months of 25 deliver the reduction in service prices that we anticipate. Gradual, slow, but declining trend. That's what we are anticipating.
It does feel as though that heat and services is still hampering the ability to move forward and at a faster pace with rate cuts. If that data point magically changed, could that mean the ECB is behind the curve with the rate cuts?
With ifs you can anticipate anything, but I think
the data's been doing that lately.
And our forecasting capacity has now significantly improved, and we've had regular, repeated forecast in terms of inflation, and we have not revisited forecast very much in the last 5 set of projections. So we are more confident, but we do not see ourselves behind the curve, and if our baseline holds, I think the anticipation that we have will put us on target, And, our target is 2%, medium term, sustainable. We want it to be sustainable. And I think that we are well positioned for that at the moment.
Your governing council members have been a vocal bunch this week. Some are spelling out the pathway for interest rate cuts.
That's the place to be vocal,
And what we've gleaned so far is that the ECB could be cutting 4 times by summer. So a quarter-point rate move at every meeting up until June, lowering rates from 3 to 2%. Does that pace seem appropriate to you at this stage, given the data points?
I leave it to them to sort of anticipate and play that game of, so many at which pace and blah, blah, blah. We have a methodology, and my job as president of the ECB is to make sure that we apply the methodology properly, that we project as well as we can, that we take into account empirical data as well, that we use our judgment. And we have to be very attentive to the rest of the world. I'll be attentive myself to the price of energy. I think that one of what probably we have not yet anticipated is the decline in energy prices, and we'll see how that pans out and what impact it has on us. So I would refrain from 4 or 3 or over the course of what time, and when do we get to 2, or is it going to be 2.25, or let's take things one step at a time. The direction is very clear. The pace, we shall see, depends on data, but gradual move is certainly something that comes to mind at the moment.
Something that has been very difficult for central bankers to do in recent times is to pin the tail on the donkey with neutral rates. Where is the neutral level? Because it seems to be jumping around thanks to various different data points, inflation coming from different quarters. How confident are you about where neutral sits in 2025?
The teams do as much work as they can to pin it down within a range that is as reduced as possible. At the moment, it's anything between 175 and 225. And people will be discussing that at length. When we get closer to that, the debate will be a little bit hotter. But it's that very, very subtle point where our monetary policy neither stimulates nor restricts, and it's a touch and go. So we'll get there.
To the point about neither stimulating or restricting, I was looking at your comments from the macroeconomic report back in December around the fiscal stance being neutral this year and next, and then tightening again in 2027. Some of the contributing factors here about investment, foreign demand, and if we are indeed talking about tariffs, to me that puts a question mark over the demand story and just how tight the fiscal stance gets. Do you see a scenario where you may have to stimulate, provide some accommodation, and perhaps we start talking about ZERP again at some point in the future?
I'm focused and concerned about what we have to provide as a central bank, and what we have to provide is price stability. This is a factor that all economic players need to have in order to determine their investment, their hiring, their policies going forward. We are in a phase of still being a bit restrictive because, as you said earlier on, we still have service prices, navigating at a little bit below 4%. The momentum is gradually declining, so that's a good sign. But this is what we are focused on at the moment. And monetary policy's got to do what monetary policy's got to do, price stability. We have, a mandate which is strictly defined. We have secondary objectives, we can talk about that, but this does not include the labour market, for instance, as the Fed would be concerned about. We look at growth. That's obvious, because growth is a factor that has an impact on inflation, and we need to be also very attentive to that. For the moment, our growth forecast for 25 is 1% and going up in 26, so we'll see.
I wanted to ask you more about the jumbo-sized rate reduction scenario, because even when it was a prospect for the ECB to discuss, there was real reluctance to embark upon something that gigantic. Even though the US went with it and other central banks were looking at 50 basis points, the ECB seemed just very cautious about a 50 basis point rate reduction, almost an emergency setting or nothing at all. What is the scenario where 50 is deployed?
I mean, we're not reluctant, because when we hiked, we went straight away to plus 50, and then we went to plus 75 basis points. So we're not afraid of that. But we started earlier. Don't forget, we started in June, and as we started earlier, it enabled us to to go not soft, but to sort of see how the economy reacted, see how our monetary policy transmitted to the economy, see how the credit conditions responded, see how financing cost declined. So it's probably more. It's, as you say, it's not jumbo, but you know, who cares about being jumbo? We want to get to target. So no, we'll do what we have to do. But at the moment, I think that having started early enough, I think, and moving gradually and predictably, indicating very clearly that we will remain data dependent, that we will look at the three elements: inflation outlook, underlying inflation, and transmission. I think, you know, some market observers or participants would like to say, oh, we need forward guidance. Tell us what you're going to do in 6 months. No, we have a method. We will apply the method, and we will take all the data as it comes in. And data is going to be fascinating. As I said, the price of energy is going to be something that might have a real impact.
We've got about 3 minutes left, so I just want to touch on a couple of other issues with you. Populism. It feels like it is everywhere in Europe again, and Germany's heading back to the polls. The French government is in a tenuous position, depending on the left and the right at any different time. Does this mean that monetary policy is again going to have to do a lot of the heavy lifting in Europe because there's so much fragmentation on the political landscape in Europe?
Monetary policy will do what it has to do. But the heavy lifting is a joint effort. And fiscal authorities, whether they are right-wing, left-wing, centre, coalition, or whatever the regime, presidential or parliamentarian, the structural reforms and the fiscal determination must respond to the voters, the consumers, and the savers' demand. If a country starts, wherever located, to start to diverge significantly in terms of fiscal discipline, does not implement structural reform in order to reap the benefits of what we have, you know, talent, money, institutional changes, I think the response by the people will not be helpful for those who care much about making policies.
Just quickly, before we hit a hard break on this conversation for the news interview, China has struggled to right-size its economy. Arguably, some of the demand issues we're seeing in Europe is because of China. How hopeful are you that China will find a foothold this year thanks to its self-help stimulus measures?
Well, there has been stimulus measures. And I think there is a refocusing. It's hard for them, I think, but there is a refocusing on the internal market and supporting consumption at home in order to, you know, have a stronger footing when entering into negotiations with the Europeans, because there will be trade negotiations between Europe and China and with other players around the world.